Hi there, and welcome to Shapers, Makers, Builders, and Breakers. I'm your host today, Benjamin Shaw. Shapers is the podcast show that brings you African leadership stories in all spheres of society, where we interview exceptional individuals telling us their story.
This podcast is brought to you by Exeo Capital. Exeo Capital is a leading alternative private equity fund manager that through its 15-year history have focused on investing in African businesses with purpose and impact. Exeo covers the whole of the African continent with investment teams based in Cape Town, South Africa and Nairobi, Kenya, currently managing investments in 9 African countries. The core investment thesis revolves around partnering with exceptional businesses and their teams that have the ability to impact Africa in the decades to come. Exeo does this through providing growth capital to these businesses, but more than that, leveraging a partnership ethos with the companies they invest in. For more information, please have a look at their website, www.exeocapital.com. That is www.exeocapital.com.
Since the start of the Shapers podcast, the approach to interviews has remained the same. Engage in peer-to-peer conversations by asking the questions that we would most like the answers to. Today on the show, we have the honor of chatting to Zach George, the managing partner of Launch Africa Ventures, shaping venture capital right across the continent. As with all episodes, this was a conversation full of best practice, tips, and insights into an industry that we're really interested in.
We hope that you will enjoy today's conversation as much as we enjoyed recording it. Without any further delay, let's dive into our next episode of Shapers, Makers, Builders, and Breakers.
Many years ago, as I was starting my own career, the glittering allure of Wall Street was a key drive behind my desire to be an investment banker. Like our guest on the show, the journey led me from leveraged and corporate finance towards venture building and startup. Zachariah George is an ex-investment banker and former head of Africa investments for UStart, a network of multi-family offices across Europe. More recently, Zach was the chief investment officer of Startupbootcamp Africa and is now the managing partner of Launch Africa Ventures, which I believe is the most prolific seed stage investor on the continent. Our paths crossed in building a startup several years ago. You were a seed investor at the time. Lots has changed since then. Thanks for coming on the show, Zach.
Thanks, Ben. It's good to be here.
Well, why don't you start off by telling us a bit about your journey to get here? You studied in America. You reached what some might call the pinnacle as a Wall Street investment banker. What was young Zach like in those days?
Yeah, thanks. It's a question I don't get asked often, but a huge part of my childhood shaped who I am today. I actually grew up in the Middle East in a small town called Muscat in Oman. You know, it's important to talk about this, especially when we are focusing on entrepreneurial journey paths. So my family grew up in the 1970s, late 70s, early 80s in Oman, where oil was first discovered in the Middle East. And there was nothing in that part of the world. And essentially, after oil was discovered, a lot of professionals, doctors, engineers, lawyers, bankers came to build the country, the region. I'm talking Oman, Saudi Arabia, Kuwait, Bahrain, etc. So I grew up in a family where we had to create something out of nothing. And as a result, my childhood was very entrepreneurial in the sense that we were surrounded by families from all over the world. We had families from Africa, from Europe, from Latin America, from India, China, that would all come to the Middle East to build an economy out of nothing. So even though my parents weren't entrepreneurs themselves, they were professionals. My father was an economist. I got to see this very entrepreneurial flair from people around me that had literally come to the middle of a desert to build hospitals, roads, schools, banks, etc. So the first sort of 15 to 16 years of my life I spent in the Middle East, and I could see this journey of young people from all over the world building things. And that subconsciously brought a level of entrepreneurship and innovation in my mind. I mean, this was pre-internet, pre-cell phones, pre-anything. So you learn to appreciate real world assets. And why is that important? because I grew up in a multicultural environment, because there was no internet and phones and etc. You relied on things like books, music, food, art, literature for intellectual stimulation, right? So at the age of 15 or 16, I went to an international school with people from literally all over the world. I was reading...
And that was in Oman?
In Oman. I was reading Hemingway, Graham Greene, Charles Dickens, listening to Elvis Presley and, Aretha Franklin, having sushi one day and Ethiopian food the next day, because there were a whole bunch of international folks that were living in the Middle East. So ironically, growing up in the middle of a desert in the 80s and early 90s was a huge plus and not a negative, because you were exposed to so much. So when you started going into university and high school, university, and grad school, it wasn't a big shock. You're like, oh, I know this, I know that. So that multicultural upbringing forced you to be very aware. And that has helped me even to this day, 40 years later, the way I interact with people, CEOs, product managers, heads of industry. You learn cultural appreciation very early on, and often like your interpersonal skills and your cultural awareness and your socio-economic awareness is what gets deals done more than just signing, documents, right? So I think my formative years, even before I got into investment banking, but in the Middle East, helped me a lot. So,
well, there's a lot to unpack there. I mean, one of the themes that comes up regularly on the pod is how forms of creativity express other than in business, and how people of interest have many interests, very diverse interests, and you've had a very diverse path. So it started in the Middle East, started in Oman. What was your family like? Did they all come to the States? Did you always want to go to the US? What was that transition?
Yeah, so I mean, I was enamored by the States from very, very, very a very young period. I mean, I went to, like I said, an international school. I was very geeky and nerdy at school, a bit like you, Ben. And sure. I top of my class several years in a row, and I wanted to go and study at MIT or Yale or Harvard or Stanford. And one of the things my family heritage is from the south of India. And there's a very technical university in India called the IIT, which stands for the Indian Institutes of Technology, which is where a lot of modern tech CEOs like Sundar Pichai from Google and Nadella from Microsoft, et cetera, have gone to. So my father wanted me to go and study in that particular school. And I'd never lived in India properly. So it was a bit of a culture shock. And I, against my own will, went and applied to a very competitive exam to get into that university. It's called the IIT. And I spent 4 years in India studying engineering. And it's an extremely competitive school, very hard to get into. And perfectly honest, I hated it. It wasn't my cup of tea. But what it did teach me is that not everything in life is just about what grades you achieve or what your position is academically. Because you're only as good as your last degree, your last job, your last accomplishment. So when I graduated from the IIT in 2003, I then said, okay, now is the opportunity for me to go and study in the US. So
to do what you wanted.
To do what I wanted. And my parents had never been to the US. I mean,
did they still live in Oman at this time?
They still lived in Oman at the time, yeah. And my father had been the representative of Oman at the IMF, the International Monetary Fund in DC. So he'd been to DC a few times on missions, but no one had actually lived in the US. So I was the first person in my family to actually go and study in the US. So I actually applied to Stanford grad school. It was a degree with the Graduate School of Business and the Graduate School of Engineering, and I specialized in management science and financial engineering. And it was very intimidating because I had no work experience. Most people go to grad school after working for at least 2 or 3 years. This was back when people didn't do applications online. Applications were handwritten.
Wow!
Because this is back in 2002.
2, 3.
Yeah, 2, 3. Yeah. So yeah, and this is important for our listeners here, is not everything is about your grades and your achievements. Often business schools will look for candidates that have the best likelihood, and these are the KPIs for business schools or just grad schools, mostly in the US, is how can you be the best ambassador for that school after you graduate?
Interesting.
Right? So if someone is really good at music, sport, public speaking, or is an innovator or a potential, entrepreneur, but doesn't have just the grades or the experience, they would get into a Harvard, a Wharton, a Stanford, an LSE, because they could be a better ambassador for the school in future and could get diverse sets of people to apply to that school because of a prominent alumni. So in my application to Stanford, I know we're digressing a bit here, but in my application to Stanford in 2002, I actually quoted Pink Floyd, Friedrich Nietzsche,
Wow.
Sigmund Freud in my applications. And I had this application saying, even though I have no work experience, my diverse upbringing in the middle of a desert in India, my music, my art, my math, etc., would make me a great candidate for Stanford. And surprisingly, I got into Stanford grad school with no work experience.
Sure.
At the age of 21.
Wow.
And that then was incredible. I can speak a whole litany about what it was like going to Stanford.
So let's double click on that briefly. I think what is important, you've made a few points. One of them being scores on everything, marks on everything. A profile needs to be more compelling than an exam. And I think it's true that there are parts of the US that really value that. You've mentioned more than just one grad school. But there are also parts of the US and the job market that do need a certain minimum level requirement. And I would argue banking is certainly one of them.
Yeah.
So you must have done well. You did well in IIT, and then you went to Stanford. The transition to what many would see as a traditional path from a grad school to Wall Street must have been quite a well, did you have that path etched out when you entered the US? And what was that like making that decision?
Yeah, great question, Ben. I actually tell people, and they find it shocking to this day, the cultural shock that I had moving from the Middle East to India to California for grad school was nothing, what paled in comparison to the cultural shock moving from California to New York.
Wow.
Which is a bit of a, mind F.
Now that is, sorry, just to comment, so that is feedback that I've heard a few times. In my time banking, we had a program in New York, which was hugely in depth. It would also bring across grads from across the world all into one training house for a month or two. And there were many times, many evenings I can remember, and people around me, that you'd almost get swallowed up by the pace and you mentioned the culture, but to me it was the pace and the transactability of every relationship that you'd make, and you'd meet so many people and everyone was doing something. And it was hugely exciting, but it was also exhausting, particularly at that stage. I was coming from South Africa and you're saying you're coming from California. Was that what you're alluding to, that sort of change of pace?
Absolutely, man. It was the fact that diversity, multiculturalism, differing points of view were celebrated all throughout my university, my grad school, especially in California. And the moment I got to New York to start working on Wall Street, it was almost like you had to regress and say, no, you need to be super conservative, dress conservatively, speak conservatively, fit in. And let's be honest, it was an all boys club. It was a house of privilege, for lack of a better word.
Sure.
You had to earn your stripes before you got in, as you know, Ben. So you had to tone yourself down. And this is like the early 2000s, right? 2004, 2005. And it was a privilege to get into that club. And there was a hierarchy. And it was made known on your first day. I remember my first day at Lehman Brothers in 2004. I was told that I had to work 14, 15 hours a day and slave away until I got from analyst to associate to vice president. And it was a shock. But I had to do it because it was what people did. So there was a certain extent of, I wouldn't use the word brainwashing because it seems a little too extreme, but you had to learn the ropes. And that was a point where I said, okay, if I have to work on Wall Street, first, by the way, grad school in the US, extremely expensive. If it's a top tier school, you'd be amazed at how many Americans are still paying off their student loans way into their 40s and 50s. So my intention was to be debt free in 3 to 4 years. So I knew that I had to work my ass off the first 3 or 4 years as an analyst and as an associate, so I could literally save my bonuses and pay off my loans. Hence the reason why I took my job on Wall Street very seriously. I didn't mind working the long hours because there was an end in sight. I had no desire to stay on Wall Street beyond 3 or 4 years. 3 or 4 years became close to 7 years. But it was a great experience. I mean, people often talk to me right now and say, gosh, that must have been pretty bad. I said, no, it was probably the best thing I did, because in your 20s, you need to make mistakes. You need to fail. You need to have bosses that give you grief. Why? Because Wall Street is a completely unforgiving environment. As an analyst, you have to have perfect Excel skills. You have to have great PowerPoint skills. You need to hone the way you talk. You cannot be an introvert and not be a people person and not be confident and be able to make presentations to people that are several years older than you and more accomplished than you. Because if you don't learn that, you will be relegated to back office, to doing quote unquote menial work.
Yeah. And I think that's what's so interesting about that is I've heard you give advice, not just to bankers, but to entrepreneurs, people who also have to walk into rooms with very senior investors often across the table, make presentations, have a fantastic Excel, be able to connect, build into a relationship, maybe over many years, maybe just over the course of a meeting. And the skill set that you would have learned, that many people learn in a bank, in an environment which is, as you say, unforgiving, can really be translated quite easily into business of any kind. Now, America is very different to Africa. So let's jump towards that direction. You moved from Wall Street, you came to Africa and you decided to make it your home. That's quite a big change. And you'd already done a lot of changing and traveling. Did you not like America, or was it something in Africa that compelled you to come? And what has the difference been as you see it?
Yeah. So funny enough, my journey to Africa started in 2008, funny enough, before the crisis. So in 2007, Bear Stearns collapsed. In 2008, Lehman went down. But what's interesting is 2 or 3 months before Lehman collapsed, I'd had a bit of a head-heart crisis moment, and I was questioning the work I was doing. Why was I working these hours and for what purpose, etc.? So I took a sabbatical for 6 weeks, and I went and did some volunteer work in Ghana. Most people don't know this about me, so I'm glad I'm able to share it on this podcast. I went to an orphanage in Ghana and volunteered for 6 weeks, teaching kids. I was at a hospital delivering babies.
Was this in Accra?
And it was actually about 2 hours north of Accra. So like proper in a village, middle of nowhere.
Different to Wall Street.
Very different, diametrically opposite to Wall Street. No blackberries. I mean, talking blackberries, yeah. It was pretty crazy, yeah. But what's interesting is you learned, it was a stark realization that there was a world outside of Paris, Milan, New York, London, and the big Tokyo, the big financial centers. And it made me realize that I could be doing so much more good and impact with the privilege of having a Wall Street CV, but doing it in better suited places across the world. And that's where my first attraction towards Africa came.
Sure.
So I spent 6 weeks in Ghana in June, July 2008. I came back to New York after this sort of sabbatical, and literally the house of cards started falling. And then literally 6 weeks later, Lehman had collapsed. So it was a stark realization to say, maybe my gut was telling me to do something. But often when the world collapses around you, you tend to be more practical and less in your head. So that's when I said, okay, cool, let me continue working in Wall Street. Barclays had bought Lehman North America. and I've stayed at Barclays for a couple of years doing M&A. But during that entire 2 year, I was plotting my exit.
Okay.
This is a message I have a lot of entrepreneurs and just people is always have a plan B. Even if you're currently executing plan A, if you're working at a corporate or a startup, always have a plan B to make sure you know what you're doing when things may not go great. So I was plotting my exit from Wall Street, and I didn't know that I wanted to come to Africa for sure, but I knew that the impact I could have in Africa would be far greater. I'd rather be a small fish in a big pond like Africa, which was completely untouched from an innovation standpoint, than just be one of millions of bankers in New York. So in 2010, when the World Cup was in South Africa, the soccer World Cup, FIFA, I thought it would be a good excuse for me to come to South Africa to watch some football and then figure out how I could start something here. And that was the premise of me coming here. And when I came here in 2010, I started working for free for a lot of microfinance institutions. If you may recall from back then, Mohammed Yunus with Grameen Bank had just taken off. He'd won the Nobel Prize.
That's Bangladeshi, if I remember.
Correct, yeah. So microfinance, especially with rural women in Bangladesh, in India, in Mexico, Peru had just taken off.
And the developing world had seen that model as being a good way to fund entrepreneurship with very low risk, because, of course, his banking methodology would lend micro amounts, as you suggest, to small entrepreneurs who are able to repay it in small increments.
Yes, that's right. So that I said, okay, if it's working in Southeast Asia or Asia in general and Latin America, why is no one doing it in Africa? So I use it as an opportunity to come here, watch some football with the World Cup, but also start exploring microfinance in Africa. So that made me quit my job on Wall Street, which was not easy. And I moved here without any specific planning, but sometimes in life, I mean, a lot of young people do gap years after high school at 18 when they have no money, no clue, no plans, and it's just using dad and mom's money. I'm a strong advocate of doing a gap year in your mid to late 20s when you've done your stint on banking, legal, doctors, whatever, and then you've got the money and you've got a more clear head to transition. I'm a huge fan of taking a year off before you transition in your early 30s. And that's what I did.
Well, that's great advice. A lot of the listeners of the pod are professionals in one sphere or another, interested in innovation or potentially the disruption that's to come. And certainly in my group of colleagues, taking a sabbatical or taking time off, even if it's to travel for a month or two, is increasingly common. And post-COVID is also supported by business, which I think is a good step forward. Okay, so we've got another thing to thank Lionel Messi for, that you had come to Africa to watch him play football. So you came here, and I've read a lot of comments that you've made. You've given some interesting articles and interviews about the opportunities and the value that you think can be unlocked in Africa. I would contend that business infrastructure, whether it's human capital, skill base of Africa, whether it's funding or lack thereof, if it's the credibility of small business owners, it's all lacking. Africa doesn't have it, certainly relative to the playground that you would have come from. You've mentioned California, New York, India at the moment, certainly doing very well. How does venture, and in particular, how does Launch Africa, which is your venture fund, how does that address this lack of infrastructure? Maybe you can tell us a bit about Launch Africa, tell us a bit about your portfolio, the sectors you're working in, the countries, and what stages of investment have you sort of focused on?
Yeah, no, absolutely. And I'll give you a quick segue into how Launch Africa started with Startupbootcamp, because that's important for our listeners. So you're right. When I came here in 2010, outside of the work I was doing with microfinance organizations and SMEs, I noticed that Africa, as you rightly pointed out, has a predominance of primary resource-driven economic interests. So you have the mines, the retailers, the banks, the insurers, and the telcos that control the movement of money. And Africa has always been an economy that's driven by primary and not secondary and tertiary. I mean, if you remember your Econ 101, right? Primary, secondary, and tertiary. So one of the things that I realized very early on, this is 2011, 2012, was to really bring into the continent a level of innovation and entrepreneurship. You had to go into who controls data and distribution from a consumer adoption perspective.
Mm-hmm.
Now, in a place like California or Tel Aviv or Bangalore or Shanghai or Berlin, like the big sort of innovation tech centers in the world, B2C businesses can really work because the level of innovation among consumers is relatively high, right? In Africa,
and what do you mean by that? The level of innovation amongst consumers, define that.
Yeah, so it's how do young people in these regions buy their food? How do they get from A to B? How do they study online? How do they buy their medicines? So because venture capital could be used to create platforms like Uber, Lyft, Airbnb, Coursera, Udemy, in every single sector of the economy, even in markets like India, right? Platforms like Ola Cab and Zomato and Swiggy and Yo-Yo Rooms, etc. All these unicorns in India and China, of course. Because there was an easy way to venture capital allows economies, countries to acquire customers at a fraction of the cost that you would if you went through mainstream media and channels, right? But in Africa, because there was a significant lack of early stage financing, the only way you could get customers to buy your product was if you went through a retailer, through a bank, through an insurer, through a telco.
Now, the distribution channels that are set up and established.
And without being too controversial, I mean, like, most of Africa is run by oligopolies. I said it. I mean, it's a pretty obvious fact. Right? You've got 4 or 5 large insurers, most of whom happen to be in South Africa, that have arms and fully owned subsidiaries on the continent. I mean, Sanlam owns Saham. Old Mutual has subsidiaries in Kenya. The same thing with the banks, EcoBank and GT and Diamond and Barclays, etc. And then the telcos, you've got MTN, Airtel, Vodacom. And Orange in Francophone Africa. So when you've got 5 to 6 major corporates in insurance, banking, retail, telco, and let's say healthcare, the question is, if you're an entrepreneur and you want to launch, let's say, a peer-to-peer payment gateway, or you want to launch an online coding academy, think someone like an Andela, you have to get into bed with the corporates.
Yep.
Otherwise, you're going to spend millions of dollars in acquiring customers, or you can do it through a revenue share or a license agreement or a JV with not 1 or 2, but multiple corporates. And
Zach, that's where you hear often the comments given by mentors or coaches, if you build in Africa, go B2B, don't go direct B2C. And in my own personal journey, I can say that certainly building through distribution with business is a hell of a lot easier than trying to acquire customers, as you say, directly.
Yeah, I mean, you need to, I say this often, but I cannot say it enough, is you've got to, in Africa, you've got to learn the subtle art of sacrificing margin for volume.
Sure.
Right? So if you're making 50 basis points on a transaction and you have 100 customers, rather make 40 basis points or 30 basis points and get 10 times the number of customers by sharing it with the telco.
Now, that example you give is certainly specific to parts of Africa and also some types of businesses, payment gateways, for example. Launch Africa has a larger focus than that. So take us back to what Launch Africa is. What is it that you and your team do? And what are your focus areas?
Yeah, so Launch Africa, we launched 3 years ago. Before that, I used to run the largest accelerator in Africa called Startupbootcamp. And what we realized was there was so little funding at the pre-seed and seed stage of an entrepreneur's business journey. So I'm talking when you've just launched your product. By the way, all of this is tech or tech enabled, because that's the only thing that can scale beyond barriers of entry. There was a lot of funding at the Series A level, which is typically when you're doing at least $1 million in annual recurring revenue.
Let me just interrupt you. Let's pause and explain to listeners exactly what the venture capital landscape looks like. So starting at pre-seed, maybe walk us through pre-seed, seed, your A, your growth rounds, and maybe even your exit.
Yeah, no, that's good. Thank you for bringing that back. Yeah, so pre-seed is when you've built an MVP, a minimal viable product. You don't necessarily have users, but you've got something that works. It could be an app, it could be a platform, it could be just a distribution showcase of anything that you're selling, but you haven't got paying users yet, right? That's when you typically go through an incubator or an accelerator that can help you optimize your product market fit to say, how can you find the right customers? And that's where corporates like banks and insurers will typically be sponsors of these incubators and accelerators. When I ran Startup Bootcamp, we had, Old Mutual, Nedbank, Woolies, MTN, etc. as corporate partners. And they're doing it without taking an equity stake, but they're there as corporate sponsors to sort of have a bird's eye view on what innovation is happening out there. Think of it as complementary to R&D.
Yeah, it's a really interesting model. And of course, venture investing goes beyond just venture capital. You've got these institutions putting money in, and that's a whole nother conversation.
Yeah.
But of course, if you don't go through one of the large sponsors, your alternate at that stage is typically friends and family and angels, right?
Yeah.
So you play more or less in that space, but you can ramp up beyond angels.
Correct.
What does that look like as you grow beyond pre-seed?
Yeah, so Launch Africa is a specialist seed and pre-series A fund. So we typically only invest in companies after they've gone through an accelerator, or if they haven't gone through an accelerator, after they've received from some friends and family and angel funding. They have to be post-product and preferably post-revenue. But I'm talking doing $20,000, $25,000 or more in monthly recurring revenue. So we're not pre-seed funders, we're seed funders, right? The big challenge, Ben, is historically, and not just historically, globally, most seed stage companies, once you approach revenue, it shouldn't take you more than at the very most 2.5 years to get to $1 million in annual recurring revenue, right? That's the trajectory of most technology startups in the world.
And that's typically where you're looking at a Series A round,
Correct.
Right? That's the benchmark that international VCs are looking for.
Yes. I mean, without putting a stake in the ground, once you're doing $1 million in net revenue annually, preferably recurring revenue, is when you're ready for a Series A. The benchmarks can be a bit higher, up to $2 million, but generally $1 million, you should be ready to start talking to VC funds, right? Regarding a Series A round. What has happened in Africa is because there's so little seed funding, entrepreneurs would take 5 to 7 years to get to $1 million in annual revenue, and only then start talking to Series A investors. Whereas your counterparts in the US, in India, in China, in Israel, in Europe, etc., would get to Series A in 2 to 3 years. So the whole point of Launch Africa was to own, or at least be a major player in the pre-Series A space, so we could invest. So Launch Africa typically invests between $100,000 to $300,000, at least our fund one, and we would lead rounds for companies in the tech and tech-enabled space. And our strategy was to allow our LPs, which are investors in our fund, to co-invest with us directly on the cap tables of these companies. So founders would not spend more than 2 to, at the very most, 3 months in a year fundraising. Because as founders, you should spend the majority of your time in operations and sales. So back in 2019, when we launched Launch Africa, the average seed round in Africa, so post-accelerator, was about $1 million, $500,000 to $1 million. So with us investing around $300,000, we could lead a significant part of the round. And then whatever was left over, we could get our LPs, which are fund investors, to co-invest with us. We wouldn't charge them fees or carry. And then other VCs could, mostly regional VCs could co-invest
syndicate
with us.
And
that was super beneficial for founders, because they could focus on their metrics and sales. So with our capital, they could they could raise a seed round relatively quickly. I'm talking a couple of months, and then they could get to Series A in 2 years versus 5, 6 years.
So that rationale makes a lot of sense. And I think it's really clear that the role of venture capital in your world, as you've explained, funding being almost the fuel to accelerate this engine from pre-seed to Series A, that fuel is critical, and getting the right sort of fuel, I suppose, is also important. But venture capital is different to silent capital. Money is money, and you could theoretically raise $200,000 at a bank.
Yeah.
So what is it that venture provides that you're passionate about and that you've built a team around, and why is syndicating it to regional VCs, for example, of benefit to the founder?
Yeah, I mean, these are great questions. I wish everyone would ask these before you raise money. So first of all, there's a big difference between angel investing, venture, and bank financing. So angel investors are people that have got networks, a bit of capital, but their value is almost entirely financial. And you've got maybe some introductions you can do, but it's fairly limited. To be a VC, you need to add significant value above and beyond just the dollars you invest. So my benchmark is, if you invest $1 in financial value add, you got to add at least another $1 in non-financial value add as a VC. What does that mean? Here are some examples of non-financial value add. If you're a VC investing into a seed stage startup, you need to be giving your startup access to, for example, corporate proof of concepts and pilots. So you got to be opening doors, and not just any doors, relevant doors
For distribution.
And it needs to happen as almost a condition of your investment, saying that
Sure.
if I'm investing in you, I'm going to make sure that an insurance company or a bank or telco can work with you, and here's a person you should speak with, and they can help you achieve this. And that needs to be consistent every quarter, right? So you've got to have these networks, especially because B2B or B2B2C in Africa is exponentially more likely to succeed than B2C. That's one very important thing. You need to be helping with access to media, conferences, summits, juries, panels, because as a founder, you have no clue how to speak at Web Summit or at South by Southwest or Slush or AfricaCom or Super Return, because you're just a young guy or girl building some tech and hoping to acquire customers. So your VC should be helping you significantly with media access. Hiring. The amount of money that startups, waste on hiring, paying huge fees to recruiters, especially if you're expanding cross-border into other markets. I'll talk about that later. So as a VC, you should really be helping with understanding cross-border expansion. How can I help you build teams in other markets? So if you're, for example, in Ghana and you want to expand into Nigeria, you should be helping your startup with understanding, how do I open a new branch? How do I handle legals and payroll and IP? And there are plenty of avenues to do this, right? Hiring is one. Co-investors. As a VC, if you're leading a round, you should be helping your founders to find co-investors. You could use your own LPs like we do, or as a leading Pan-African VC, we make a few phone calls to regional VCs because they can add value from an HR, an admin, access to clients, you name it, right? So
Now, Zach, a lot of what you've just mentioned, in fact, I would categorize all of it as being driven by network.
yes.
So it's very difficult to pick up the phone if you're not sure who to call, or if you haven't actually visited and got to know the bank manager or the hiring manager or the recruiter or whoever it is that you're working with. What sort of network capability does Africa have? Are we ahead or behind the rest of the world? Is it very collaborative? Do you find that as one of your big benefits of being Launch Africa for a founder?
Yeah, I mean, you'd be amazed how open and collaborative people are if they don't feel threatened by what you do. So venture capital in Africa is still tiny. I mean, venture in Africa last year crossed the $5 billion mark, which may not seem like a lot. But remember, venture capital in Africa in 2015, which is only 7 years ago, was 100 million. So it's grown from 100 million to 5 billion in 7 years. And there's nowhere on this entire planet where you've seen the industry grow as quickly as it is in Africa.
And it's still lagging population growth, so we're going to see it accelerate further.
Absolutely. This arbitrage. Sorry, I can't take Wall Street words out of my mouth, but population growth. Africa accounts for about almost 20% of the world's population, about 7% of the world's GDP, maybe a bit less, 6%, but only 1% of the world's VC. So there's a double arbitrage in Africa, GDP and population. So, and the other thing is, Africa is the fastest growing region in the world from a population perspective, but it's also the world's youngest continent.
Sure.
So the average age in Africa is 19. The average age in Europe is 39. The average age in the US is 34. So why is that important, Ben? Is because and by the way, the average age in Africa in 2050 is going to be even lower, predicted to be 15.
Sure.
So why is that important? Because young people in Africa are more digitally native than older people, quite obvious. But also you have a significantly higher penetration of smartphones in Africa than anywhere else in the world. It's a little crazy stat that our listeners might find interesting. In 2001, the turn of the millennia, there were more smartphones in Manhattan than the whole of Africa.
Wow.
True story.
Wow.
In 2001. Now there are more smartphones in Africa than the whole of North America.
Sure.
So we've seen a significant boom, and the power of two things: mobile phones, cheaper mobile phones, the lower cost of data in Africa. So when I came here during the World Cup in 2010, the average cost of data, as in for 1 gig of data, was around 45 to 50 US dollars.
Unbelievable,
right? Today, in 2023, the average cost of data across 54 countries in Africa is about $3.
Oh.
So that means that you have a significant number of people, especially youth, that can transact on their phones because it's cheap. There are more phones and the cost of data is lower. So
and you hear this term leapfrogging quite often. I know we've discussed this, I think, on a panel before. Africa, in some ways, has leapfrogged other areas of the market, coming back to our earlier point on infrastructure, because mobile doesn't just upgrade, it can, in many cases, replace the fixed line, for example, of data, which was carried through the US. Cable TV is another example. Absolutely. Where you're streaming directly now from the providers, and that's a massive market opportunity in Africa. So Launch Africa focuses on Africa quite obviously. You focus on pre-seed, and you're in sectors that are tech-enabled.
Yeah.
What are you looking for in the market? And maybe for our listeners who are entrepreneurial or potentially founders of their own venture and saying, I want to position for that, what are the hallmarks of a good deal or good business at the stage that you look at?
Yeah, I mean it's several points, and I'll try and be concise here. But when we get into, so by the way, we are a Pan-African fund. We've in our first fund that was fully deployed in Q1 of this year, we've invested in 133 startups across 22 different African countries.
That's phenomenal.
Quite insane.
And for context, as far as I'm aware, the average VC fund, albeit with slightly larger tickets, average VC fund will invest between 15 and 30 over its deployment life cycle, which is usually 5 to 6 years. Of course, a fund then returns its capital or tries to exit those investments over the following 5 to 6 years.
Yes.
So you're looking at a portfolio which is almost 4 times that size, and it's now over 22 countries.
Yeah, and the reason we had to do this was because there was absolutely no capital available, Ben, as little as 3 or 4 years ago at this stage. All the capital was sitting almost stagnant at Series A and Series B. And then you have these great Series A and B funds in Africa, the likes of Partech, African Vest, Novastar,
and some of the internationals now deploying Africa mandates,
and writing checks of 2 to 5 to sometimes $10 million at Series A and Series B. And the question was, where were they getting their deal flow from? And so hence the reason why it was important for us to cover the whole continent. And you can only cover an entire continent if you have partnerships. So we had partnerships with all the leading accelerators from Flat Six Labs in Egypt and Tunisia, all the way down to the likes of Endeavor, AlphaCode, etc. in South Africa, and everywhere in between. So obviously the four biggest markets in Africa are Egypt, from a geographical perspective, Egypt in the north, Nigeria in the west, and Ghana, Kenya in the east, and South Africa in the south, right? They account regularly for between 70 to 80% of all the venture activity, with Francophone Africa, Senegal, and Cote d'Ivoire really picking up. I would say that's the market to be looking out for in the next couple of years. But from an entrepreneur perspective, listening to this podcast, what are we looking for? 3 high-level things. You've got to be in a market that has a steady adoption of tech and tech-enabled resources. So be it healthcare, education, financial services, or retail, logistics, mobility, you need to be, you cannot build a unicorn or a half unicorn in Gabon or Equatorial Guinea because the population is too small. So even if you're a local startup in those regions, think global from day one. A great example that I often give people as a counterpart in Latin America is a company called dLocal. dLocal is one of the top payment gateways in the world, but focused on Latin America. And they started in Montevideo in Uruguay. But they very quickly expanded to Brazil and Mexico and are now one of the top payment gateways. They're listed on the NASDAQ. And they're now looking to expand into Africa. Right. So just because you happen to be an entrepreneur in a smaller country like a Benin or a Togo or Tunisia, for example, does not mean that you have to limit yourself to only that country. And this is why B2B is super important. If you happen to be hypothetically in Cote d'Ivoire and your product offering is built on a B2B2C partnership with Orange as the largest telco in Francophone Africa, they can help you expand into 14 different countries in Francophone West Africa. But you have to be a big picture thinker as an entrepreneur. So market size, extremely important, irrespective of where your home market is. Number 2, do you have the ability to work with multiple corporates? Very important for us. And number 3, are there enough later stage investors that understand distribution and scale that can help you scale beyond Series A? If you meet those 3 high level criteria, everything else, your team, your traction, your tech, your timing, all that can be, to use a millennial term, finessed. But you need to get those first 3, your market size, your distribution, and your later stage investors. And that's where we spend a lot of our time from a DD perspective. Compared to other VCs, early stage investing does not involve you spending hours and days and weeks on a 5-year financial model in Excel. You need to have a basic projection of how you intend to grow. But a 5-year financial model, when you're doing $10,000 in monthly revenue, doesn't mean a lot. It's entirely thumbsuck. But yeah,
that's tremendous wisdom, Zach. I wish I had understood better the need to position for that exit round for those long-term investors coming in post-seed stage. And I think it's wisdom that, particularly because Africa doesn't have a cohort of very successful founders pushing back into the system, we miss out on that level of mentorship. And it's great to hear it come from yourself on the coalface. I think that the other thing that you mentioned there, which is so interesting, is your market size shouldn't be constrained by geography.
Yeah.
Now, not all of our listeners are entrepreneurs. They're not all founders. We have policymakers, we have investors, people who are able to perhaps more impact the environment of these companies than the companies themselves. What advice or what enablers should be focused on by these people? Maybe it's parameters or risk assessments. Maybe it's policy. What works and what would you like to see more of to enable Africa, an African venture?
I think it actually starts from, you got to start from the end in sight, right? So where's corporate Africa seeing, to use a Wall Street term again, to seeing alpha in its returns? So like, where are the likes of, without singling out anyone particular, but it's a relevant case. Where is MTN and Vodacom going to make most of its money in the future? It's certainly not by selling SIM cards. I'm gonna,
Got an limb there.
Yeah. right? Because where are the banks making money? You can't make money just by selling mortgages, right? Insurance companies cannot be significant in the next 10 years by just selling insurance policies, right? So the question is, there is no other option than for large corporations in Africa to be innovative and partner with startups, right? I mean, I give the example often of what PayPal did in the 90s, which was a stroke of brilliance, right, with Musk and Thiel. So when PayPal started the world's first, I mean, the first versions of PayPal used, I'm not sure how old our listeners are, used Palm Pilots.
Yep.
Right?
Yeah.
But
that was pre-BlackBerry.
It was pre-BlackBerry, right? And PayPal was approached by several banks in the US to be acquired. And the genius of the founders of PayPal, they're often called the PayPal Mafia, the 7 founders that
Or
eventually...
X.com
X.com.
and PayPal, yeah.
Yeah. And exactly. Was that they forced the banking sector in the US to partner with them versus acquire them and become small fish. So it's the same thing you're seeing today, and it's beautiful to watch, is the large corporates in Africa realize that unless you partner with startups, and let's just bring it back home to South Africa for a little bit. If you look at the likes of just the big insurers, Sanlam, Old Mutual, MMA, Discovery, all of them are in some way, shape, or form partnering with insurtechs like Pineapple, like Naked, like Control, because they know that their bread and butter are not going to be 50 to 60-year-old males that are buying policies from brokers with briefcases, with leather briefcases. It's young people. So there has to be more corporate startup collaboration. As a result, innovation needs to be in the DNA of these corporates. And the only way they can do that is by partnering with startups. Initially from a commercial perspective, but later on with the view to take minority stakes in these companies. And this is an important point, Ben, and our listeners, because now you're enabling M&A, which is the big concern.
It's a big driver for exit.
Absolutely.
So that liquidity, and it's a point you and I discussed very recently, that liquidity in the market at exit is actually what should be driving many of the decisions made between that exit and Series A.
Absolutely, yeah. I mean, let's talk exits for a couple of minutes. I mean, ultimately, VCs aren't charities. So when you invest at a pre-seed or seed stage, you're expecting to get your capital back from an individual investment in, I would say, 4 to 5 years, maybe a bit longer, depending on what sector you're investing in. So ultimately, liquidity for venture capital investors needs to happen primarily through M&A. The IPO market in Africa is not that good. You could argue that the IPO market globally is going through a seismic shift, because from a philosophical perspective, the moment your stock is publicly listed, you're now, the mercy of your market cap is at the hands of retail investors.
And we've seen over the last few years, and particularly during COVID, that not all retail investors have everyone's best interest at heart.
Correct. A lot of them act purely out of emotion or have groupthink mentalities or herd mentalities. So you can see a lot of stocks today, not the big blue chips ones, but the sort of second, third, fourth tier companies, where the market value of these stocks do not really correlate with the stock's fundamentals.
Which, of course, is leveled against private valuations and has been for so long that's now, the fact that it's now in the public market as well removes one level of perceived risk between the two.
Yes.
So there's a leveling out that's happening, which I imagine is your point, that the benefits of going public are less clear.
Yeah. I mean, previously the sole benefit used to be liquidity. Right, but that is often countered by the fact that the true value of a company is better accentuated by strategic, intelligent investors, which are large hedge funds, private equity firms, such as the firms that you're involved with, and et cetera. So you'd see a lot of. So what's interesting from an M&A perspective, and I'll throw some numbers out there, which is important for listeners. In the last 4 years, from 2019 till today, there have been 130 to 140 exits in the venture space in Africa. This is an important stat. And South Africa leads that by a country mile. So South Africa has the most M&A of all the four major regions. And that M&A is driven by corporate M&A. So you have firms like Naspers, Old Mutual, MTN, the big banks, etc., that are very acquisitive. But they're acquiring companies for two main reasons. One is FOMO, fear of missing out, and one is acqui-hiring. So I will do it to acquire customers and to prevent my own lunch being eaten or taken away from me, which is a good thing from an exit perspective and liquidity for both founders and early investors. However, the multiples that corporates pay as a function of either EBITDA, revenue, or transaction volumes, let's be honest, ain't that great.
Well, I think that point itself is worth just dwelling on. The fact that corporates are considering these acquisitions for acqui-hire purposes or for innovation, but then still choosing to value them on EBITDA or net profit multiples gives you an indication of how difficult it is to position that company well. If you're positioning a startup or indeed a growing company for growth, you've got different metrics that you focused on than cash distribution as a form of dividend or net profit. And in some cases, there'll be venture capital firms very unhappy with you for just distributing cash to shareholders, although from a corporate perspective, that's what will reward you in value.
Yeah, and Ben, you make a very good point. And this isn't ideal. I think exits are a bit of a vanity metric if it comes purely from corporate M&A. What's really important, and this is a sign of a maturing ecosystem, is there are two concepts. You've got vertical M&A, which is large corporates buying startups, and then there's horizontal M&A, which is larger fintechs buying smaller fintechs, larger e-commerce companies buying smaller e-commerce companies. And when you see more horizontal M&A versus vertical M&A over a period of time, you can see a startup ecosystem maturing. So for example, the first major horizontal M&A in Africa was Stripe buying Paystack. So you have a larger fintech that has nothing to do with banks, but they work with banks like Stripe, buying Paystack for $200 million, right? It was actually more because it was it was part stock, part cash. Now that you get paid much higher multiples than a corporate. So without giving exact numbers, the multiple of ARR, annual recurring revenue, that Stripe paid for Paystack was a double-digit multiple.
Sure.
Right? Now, that's good for the entire ecosystem.
For sure.
Because you have smart buyers buying companies for market expansion and distribution. Stripe buying Paystack was their window to take on the African continent, right? This is very important. The same thing is happening now in the edtech space. Andela looking to acquire companies. MFS Africa looking to buy smaller fintechs. Flutterwave looking to buy fintechs that are complementary to what they do. So when you see horizontal M&A increasing with better multiples, it is a sign that an ecosystem is maturing. And that provides a lot of confidence to founders to build the companies. And there's nothing wrong in building a company for an M&A.
Well, it comes back to your earlier point, the three pieces of advice, one of them being position yourself for exit, have that as one of your visions as you build a company. And of course, the other example in education is 2U. Get Smartest founders have stayed in the ecosystem. They've continued to build. The money that has come in from their exit has come back into the ecosystem for new venture. And I mean, that is ultimately what makes a place like Silicon Valley so compelling, that the people who win there keep trying. They come back, they fund more risky or more exciting venture, and it sort of perpetuates. It's a virtuous cycle.
You need to have that recycling of capital. If you don't have that, the ecosystem stagnates. So if you look at who are the GPs of the top VC funds in the US, and now increasingly in markets like India and then some parts of Europe, a lot of the GPs are ex-founders. They've had exits. Doesn't have to be unicorns. Could be $100 million companies.
Yep.
And they've used their knowledge of how to build and scale a company to now invest in other founders.
Yeah, and not all of the top founders make good investors. Some of the best investors are failed founders because they've learned the hard lessons.
Correct.
And they understand what it's like to be on
Like
the other
yourself.
side of. Well, we'll see. We've got some work to do. Let's tie back to the banking experience. I often say to people, whatever they've heard about banking, the good and the bad, it's probably true. So, what do you wish people knew about venture investing? Similar to everyone has a conception about banking. What do you wish people knew about it, or what do they take away on venture in Africa?
Yeah, I think venture capital and being a VC has rather unfortunately been overhyped, glamorized, and being purported to be a very, dare I use the word, sexy career. I'm here to dispel that myth. It's not. Venture capital is an extremely grueling career that requires significant amount of financial prowess, because here you are evaluating companies that don't have years of financial history. A lot of your analysis and DD, due diligence, is more of an art than a science. And it requires working in very unstructured environments. And you have to do that for multiple companies. So it's almost like being the COO of multiple companies part-time. And that is not for everyone.
No, it's not for everyone. And I was hoping you'd bring up the financial part. That's why I was asking about the banking experience.
Yeah.
What have you taken from banking that helps you or stands you in good stead in that environment, having to be a part executive in some of the investments you've made?
Yeah, I think the one thing I would say has really helped me from a banking perspective is the ability to have a bird's eye view on a company. And I mean, I was an M&A banker for almost 5 years at Lehman Brothers, and then delved into Barclays. And it was sell-side M&A. So our job was to look at a company's financials and present the best case on behalf of that company to potential acquirers, right? So that involves
a big role of a VC exiting to Series A now.
Correct, exactly. I mean, it's literally like understanding how you can convert, this is important, activations to clients to revenue to referrals, and referrals to recurring revenue, right? And then at the same time managing your churn or your drop-offs, right? Which is basically what investment banks have done when they do sell-side M&A, but for much larger companies. So, I mean, venture capital and investment banking aren't that different. It's just you're dealing with smaller companies.
Yeah,
right?
Far smaller, I would imagine.
Far smaller.
Far smaller.
And I think that level of skill set is super important. But the one thing you have to take away from your banking days is to take away that level of conservatism where cash flow and EBITDA are the only metrics that matter. Because if you still hold on to that aspect of your banking career when you move into VC, you're going to miss out on a lot of good deals. And it's this constant dichotomy of, do I push all my money into marketing and growth? I mean, when I was in banking, to hear a company spending more than 2 or 3% of its revenue on marketing was unheard of. And in classic Silicon Valley style VC, you should be spending 30 to 35 to 40% of your capital on marketing.
Yeah.
Because it's all about top line growth. So it's an interesting mix between the two then. Yeah.
Oh, it's really, really interesting. And to borrow from the Wall Street vernacular, one of the ways I've heard venture deals described, and I think it's very helpful, is investors in stable companies are looking at risk return in terms of cash and EBITDA and metrics that would be consistent across a peer group. Investors or venture investors looking at venture capital opportunities are evaluating out of the money options to understand how deep out of the money they are. And I think that that's really helpful, because then, as you say, it's a similar sort of work, but it's a fundamentally different instrument. You're not comparing apples to apples.
Yeah.
And that's helped me really categorize businesses into how you'd analyze them differently.
I've never heard that before, and it's so brilliant. I mean, for the people on this podcast that understand option pricing, yes, venture is entirely you're looking at out of the money call options. And what's even, I'm going to take it even further, is you got to figure out how can I sell that option when it is closer to being in the money to another investor? Because I'm never going to exercise that call option. I'm going to sell it to someone else, and the purchase price, the premium on that option gets bigger and bigger and bigger. Because ultimately, when you're investing this early in a startup, and I mean, you could argue that exercising a call option is the same as M&A. There's an exit, but an option will not be exercised at seed, Series A or Series B. There'll be multiple iterations of that option being sold at higher premiums to other investors before it's eventually exercised. And it's a brilliant analogy.
It certainly helps put in context what work it is that you're trying to do. And as I say, as you've said, the work post Series A and pre-Series A is different. And I think that helps. Now, we've just relied on some of the education that we've both had in banking or in the financial services sector. There is a misconception that entrepreneurship and education are two sides of the same coin, but they're not actually. They work fundamentally differently. That education is either necessary or that you shouldn't get an education. You don't need to study. You should just go and learn as you build. Where do you land on it? Is it a discussion that's being held? And how do we look at it when we're evaluating these opportunities?
Yeah, it's a tough one, Ben, because I've changed my view on this several times over the last decade. I used to be a huge proponent of kids going to great universities, going to business school. I mean, I myself went the whole grad school route. I think my position in that has shifted significantly in the last few years. The reason why is there's a lot of stuff we get taught at grad school and even university that is just not relevant to the real world. I mean, I don't know. I mean, unless I'm giving an extreme example, but knowing the periodic table by heart doesn't help you unless you happen to be a chemist, right? Or knowing
a chemist that doesn't know how to use Google.
Doesn't know how to use Google. So, but I think at the same time, you need to have a basic understanding of math, physics, biology, science, geography, history from an awareness perspective. So, a high school degree, absolutely essential, and a basic university degree, irrespective of what it is, important. Do I think generic degrees, and please, I hope no one's going to take offense to this, like commerce or art or marketing or sales is really going to stand you in good stead when you look at an entrepreneurial career path? I don't think so. Specialized degrees, medicine, law, engineering will continue to be important. But if you're an entrepreneur, I don't really see the need for getting a PhD or a master's degree in anything. What really needs to be focused on is specialized skills. So a lot of the large companies like Apple, Google, Microsoft now, Amazon for that matter, are saying, do short bite-sized courses in something very specific. It could be digital marketing, it could be data science, it could be even things like behavioral economics, as consumer psychology. I read somewhere, I'm not sure, how long ago this was, but I think the second or third largest percentage of hires that Amazon does after data scientists are consumer psychologists.
Wow.
Because that's basically what helps. Business. That's your business, right? So, which is why you'll see things like Udemy, Coursera, and Andela, are completely redefining the way people learn. So it's bite-sized chunks of knowledge that are very specific to your work that tend to be more important than big fancy degrees from big universities if you want to follow a path of entrepreneurship, right?
So those skills developed, I think makes a lot of sense. Certainly, as you say, the literature is coming out showing that acquiring skills that are directly applicable to business is more valuable to business. What about networking? Is that not a reason to consider education? Are there other methods or forms of that are emerging across Africa?
Yeah, I mean, networking is super important. I mean, it's said often that your net worth is your network, or your network is your net worth. Sorry, the other way around. I often joke around. Some people ask me, "Gosh, Zach, what was it like going to Stanford?" I said, it was a couple of $100,000 that I paid for an email address. It's the world's most expensive email address, because you can email anyone in the world with a Stanford alumni email and they'll reply to you because you went to that school. Listen, I think if you go to a top 10 school anywhere in the world, it's worth it. I don't necessarily think that schools are the only way to build your network. I think the one thing I will talk about networking is you have to learn to give first before you ask. The world has too many people that are asking, and nothing wrong with asking for help, for resources, for funding, for whatever. But from a fundamental point, if you have expertise in anything, you always have to learn to offer before you can get. And if it means that you need to get out of your comfort zone and talk to people at conferences, events, summits, networking events, it's important. As an entrepreneur, if you cannot do it yourself, find someone, hire someone that can be your eyes and ears on the ground at events, because without a network, it's very, very, very hard to scale a company. The other exception is if you have a lot of money. If you have a lot of money to invest in customer acquisition, you can, but you need to be out there and building your networks. If it's through school networks, if it's through corporate startup events, you just have to be out there, especially if you're an entrepreneur. You can't afford to be a complete introvert, just building product and tech, if you're not out there constantly and getting other people to vouch for what you do. Yeah.
That's a lot of wisdom. Thanks, Zach. That's got me pretty excited about the space you're in. I think Launch Africa certainly is making a big impact and a big difference across the continent. And hopefully, coming from today, people not only understand the space better, but also have a sense of the people operating it. Not everyone has your profile, but many of the operators in the industry have the similar passion and vision for Africa and how we can make a difference and build value. Maybe just an opportunity as we end and get the pod out. Anything else you wanted to share with our listeners? Maybe some advice as we end.
Yeah, I would say as an entrepreneur, one of the things that I have seen that entrepreneurs struggle with the most is entrepreneurs spend way too much time focusing on tech and product and building. And nothing wrong with being a builder. Builders are the ones that create. I love creators. For all my sins as a banker and a lawyer, service providers, ultimately entrepreneurs are creators, right? The problem with being too focused and almost too creative and too passionate about what you do is you're like a racehorse. You forget what's around you.
And you hope you're going in the right direction.
In the right direction. So one piece of advice I would say is, as VCs, we come across so many businesses. We often understand the macro so much better than the entrepreneur. So if I'm talking to, let's say, a business that's doing cross-border logistics, and I ask an entrepreneur, tell us about the ecosystem. What are your competitors doing? What are your suppliers? What are your clients doing? What are the average margins? What are the profitability metrics? What are the cost of acquiring? What is your LTV, your lifetime value? What are your customer acquisition costs? The number of entrepreneurs that have no clue or very little information is shocking. So there needs to be a significant amount of more time that entrepreneurs spend on doing proper market research, because you cannot expect investors to do all that for you. Why should they? It's your industry. So if not the CEO, you need someone on your team to be constantly on top of two things. Trends in your industry. So how is AI affecting your industry? How is regulation affecting your industry? What's happening with free trade agreements? What's happening with margins? All of that. but you also have to be on top of what your suppliers are doing, what your competitor is doing. And I know it's not directly affecting your bottom line today, but it will tomorrow, next week, and next quarter.
Which is what the VC is looking for.
Which is what the VCs are looking for. So entrepreneurs really need to be, and this is the CEO's job. A CEO is the ultimate salesman of a company. The moment a CEO responds to a question and says, if someone says, hey, how is your market growing in Egypt or in Nigeria? And tell us about your expected time to break even. And if the answer is, hey, talk to my CFO, you've lost it. Because a CEO needs to really understand the business on a holistic level. CEOs, and this is very important, storytelling at the seed stage and pre-Series A stage, extremely
that narrative,
important.
the vision that you set.
You need to be able to convert your vision into something actual. And VCs and investors make decisions at this stage based on that, on your story. Success is not as important as significance.
Sure.
Right?
Success is not as important as significance.
Because anyone can be successful, right? The trader on the street that sells used cars is probably very successful, but he or she will never be significant. Tech entrepreneurs sell significance, right? And once you get into your Series A and you're doing $1 million in revenue, then the team can sort of run with it and your VCs can help you. But at the early stage, you gotta understand significance more than success.
Sure.
And that's what ultimately sells.
That's brilliant, Zach. Thank you. Thanks so much for your time. It's been great. Anything that you'd like to share in terms of contact details? How can people reach out to you, find out about Launch Africa, maybe get hold of you personally? Maybe just share that with our listeners.
Yeah, sure. I mean, we're reachable. I'm pretty reachable and open through email, even through personal messages. So I'm on LinkedIn, just Zachariah George. And my email is Zach, ZACH, @launchafrica.vc. So if you're an entrepreneur that is post-revenue focused on B2B tech across Africa, reach out to us. We're launching our next fund in a couple of months. And on the converse side, if you're an investor looking to get exposure to this very, very lucrative asset class of Pan-African tech, feel free to reach out to us from an exposure perspective. And yeah, looking forward to working with you all.
Thank you very much.
Thank you, Ben. Thanks a lot. This was great.
Thank you for listening to this episode of Shapers, Makers, Builders and Breakers. We trust that you've been encouraged by what you've just heard. Subscribe to future episodes and find out more about us at shaperspodcast.co.za. That is shaperspodcast.co.za.
Well, that's right. Don't forget to subscribe for new episodes and other content. And remember, share any feedback with us. We'd love to hear from you. Find me on Twitter at B_D_Shaw or via email. We look forward to your company the next time on Shapers, Makers, Builders and Breakers. Until that time, cheers, bye-bye.